Your retirement wasn't stolen overnight. It's been drained in slow motion for decades. Every financial disaster looks obvious in hindsight. Before the collapse, before the headlines, before the panic, there are always silent decisions made in private rooms that rewrite the fate of millions. Today, we uncover the system that promised financial security, then quietly bet your future on a math equation that never worked. This is the truth behind the coming pension collapse. Who caused it? Who will escape it? And why the biggest financial crisis of our lifetime won't hit the markets first. It will hit you. For decades, governments and companies promised you one thing: work hard now, retire in peace later. A simple deal, a fair deal, a deal millions built their lives around. But here's the truth. The pension system is mathematically bankrupt. Not in 10 years, not in 20 years, now. State pensions, federal pensions, teacher pensions, police pensions, corporate pensions, public sector pensions. Everywhere you look, the numbers don't add up. Not even close. This isn't fear. This isn't speculation. This is accounting reality. The world's largest pension systems are underfunded, overpromised, mismanaged, politically abused, and financially doomed. The middle class had its income stolen. The housing market made ownership impossible. Inflation destroyed savings. The final blow? A retirement system that cannot pay what it owes. Most people believe pensions are funded and safely invested. But that's not how pensions work. Pensions were designed in the 1940s and 1950s during an era with high birth rates, growing economies, strong unions, high interest rates, expanding workforces, shorter life expectancy. The system assumed more workers equals more pension contributions, stable payouts. But the world changed. Today we have aging populations, shrinking workforces, longer life expectancy, lower interest rates, higher healthcare costs, massive government debt. The math that made pensions possible no longer exists. The system didn't break. The world outgrew it. And instead of fixing it, politicians made a fatal choice. Keep the promises, knowing they can't be paid. Every crisis has a breaking point. For pensions, that point was 2008. When markets collapsed, pension funds lost billions overnight. Corporate plans were destroyed. Public pensions became deeply negative. Investment returns evaporated. Contributions dried up. But the real damage wasn't 2008 itself. It was the aftermath. To save the system, central banks cut interest rates to zero. What does zero interest mean? It means pension funds, which depend on stable, safe returns, were suddenly earning nothing on the safest investments. The system wasn't just wounded, it was crippled. Because pensions were never designed for a world where money was almost free, returns were tiny, and risk was the only way to grow. So what did governments and pension managers do? They took more risk, a lot more. They invested in hedge funds, private equity, high-yield debt, venture capital, real estate bubbles, derivatives. They gambled with your future to avoid admitting the truth. Guarantees are political tools. They win votes. They make people feel safe. They keep the illusion alive. But financially, a pension guarantee means nothing if the money does not exist. Here's the truth. U.S. public pensions are underfunded by $1.4 trillion. European pensions face demographic collapse. Japan's pension system is running at a structural deficit. China's state pension will start shrinking by 2035. Corporate pensions are disappearing across the West. And yet, governments keep promising more. More benefits, earlier retirement, higher cost of living adjustments, expanded Social Security, all funded by fewer workers and exploding national debts. This doesn't require conspiracy. It requires math. And the math says the promises cannot be kept. Pension collapse won't happen in a single moment. It will happen in 3 predictable waves. Trigger 1, demographics. Too many retirees. Too few workers. Too long a life expectancy. Not enough contributions. Trigger 2, markets. A major market drop shatters pension asset values. 2008 nearly did it. 2020 almost did it again. One more severe downturn, and half the world's pensions go insolvent overnight. Trigger 3, inflation. Inflation destroys the real value of pensions. Adjustments rarely match price increases. Most retirees become poorer every year, quietly. These triggers aren't hypothetical. They are happening right now. The collapse won't be loud. It won't be dramatic. It will be silent, slow, and devastating. Whenever the pension crisis is mentioned, the solution always sounds simple. Raise taxes, raise retirement age, reduce benefits. But here's the truth. Governments can't fix pensions, not because they don't want to, but because every solution destroys the system politically or economically. Let's break it down. Option 1, raise taxes. Unpopular. Kills economic growth. Punishes workers already struggling. Every dollar taken from workers makes the demographic ratio worse. Option 2, reduce benefits. Political suicide. Retirees vote, and they vote in massive numbers. Cutting pensions triggers protests, riots, and political collapse. Look at France 2023, Greece 2011, Argentina repeatedly, U.S. protests over Social Security. Any politician who touches pensions loses their career instantly. Option 3, raise retirement age. Mathematically necessary. Politically impossible. People hate it. Unions fight it. Blue-collar workers can't physically handle it. Option 4, print the money. The easiest option. The most dangerous. Printing money to fund pensions creates inflation, which destroys the real value of pensions anyway. It's a paradox. Print money. Inflation rises. Pensions buy less. Retirees suffer. Option 5, invest aggressively. This is what most pension systems do now. But aggressive investment creates risk, and risk doesn't mix with elderly people's life savings. This is why governments can't fix pensions. Every solution breaks something else. If you think the pension crisis is big, you're underestimating it. Way underestimating it. Globally, pension systems are underfunded by $137 trillion. Let's break it down. United States, $28 trillion short. European Union, $44 trillion short. China, $18 trillion short. Japan, $10 trillion short. Rest of world, $37 trillion short. This is not a future problem. This is the current deficit. If every pension system froze today, no new retirees, no new promises, they would still be short $137 trillion. To put that in perspective, that's more than the GDP of the entire planet. That's more than all the world's stock markets combined. That's a shortfall so large it can never be repaid. This isn't a gap, it's a black hole. And every year, the gap grows larger. Like gravity, pulling everything toward collapse. Corporate pensions used to be the pride of the middle class. Work 30 to 40 years, get a stable retirement. Simple. Today, only 6% of private companies still offer traditional pensions. Why? Because corporations realized something before governments did. Pensions are unaffordable, so they quietly replaced pensions with 401ks. A system that shifts all risk to the worker. If markets fall, you lose. If inflation rises, you lose. If you outlive your savings, you lose. The greatest retirement shift in history happened silently. Guaranteed income became optional savings. Companies didn't just end pensions, they offloaded responsibility. A pension collapse is catastrophic for governments. For corporations, it's already complete. Nowhere is the pension crisis more dangerous than the US, because Social Security, the foundation of American retirement, is collapsing. Here are the facts. Social Security will run out of full funding by 2033. After that, it can only pay 77% of promised benefits. Disability insurance is already under strain. Medicare is projected to go insolvent even sooner. The trust fund is filled with IOUs, not cash. The demographic ratio is broken beyond repair. In 1960, 5.1 workers supported one retiree. Today, 2.8 workers per retiree. By 2040, 1.9 workers per retiree. This isn't a system. This is a countdown, and the clock is ticking faster every year. Social Security doesn't collapse instantly. It collapses mathematically. The promises are fixed. The funding is not. If you want to know the real killer behind the pension crisis, it's not economics, it's demographics. For the first time in modern history, populations are aging, workforces are shrinking, birth rates are falling, longevity is skyrocketing, dependency ratios are exploding. Japan hit this wall first. Europe is next. China is accelerating faster than anyone expected. The US is only behind because of immigration. The world built a retirement system for a world that doesn't exist anymore. And here's the darkest part. Every long-lived generation bankrupts the next one. Longer life is a gift, but for the pension system, it's a fatal blow. Demographics aren't opinions, they're math, and this math is merciless. Inflation isn't just rising prices. Inflation is the devaluation of your time. Every hour you spent working, every paycheck you earned, every dollar you saved is worth less than before. Inflation is not an accident. It is the default strategy of every government that cannot afford its promises. Here's how inflation destroys pensions. 1. It erodes fixed benefits. If your pension pays $2,000 per month, but food and housing rise 40% over a decade, your pension shrinks silently. 2. It lowers real investment returns. Pension funds rely on a 7 to 8% return. Inflation eats half of that immediately. It forces pensions to take more risk. Safer investments no longer work. So funds chase yield and gamble your future. It makes future benefits unaffordable. The cost of keeping promises rises every year. This is the real purpose of inflation. Inflation is how governments default without telling you they defaulted. The middle class thinks inflation is temporary. Retirees think it's manageable. Politicians pretend it's normal. But inflation is the most powerful financial weapon on earth because it destroys wealth quietly, silently, invisibly. And for pensions, inflation is fatal. Millennials and Gen Z were told they would inherit the most prosperous world in history. Instead, they inherited record student debt, record housing prices, record healthcare costs, record inflation, record taxation, record financial instability, and the lowest job security in modern history. The truth? Millennials will work longer and retire poorer than any generation in 150 years. Gen Z is set to do even worse. Why? Because pensions rely on new workers funding old retirees. But millennials entered the workforce with low wages and high debt. And Gen Z is entering an economy with automation, AI, and shrinking middle-class income. This destroys the base of the pyramid, the contributions that keep pensions alive. For the first time ever, young generations are poorer than the generations before them. This is the death sentence for the pension system. You cannot build a retirement system on a generation that can barely afford rent. When people worry about pensions, politicians give the same answer. Don't worry, the government will step in. But step in with what? Governments are drowning in debt. U.S. national debt, $34.1 trillion. EU debt spiraling upward. Japan, 260% debt to GDP. China, struggling with local government defaults. And pensions are already one of the biggest expenses. If governments step in, they have two tools. Tool number one, print the money. This destroys the value of pensions. Tool number two, cut benefits. This destroys political careers. It's a trap. No politician can fix the pension system without committing political suicide. So instead, they delay, they deny, they lie. They say, fully funded until 2033, minor adjustments needed, stronger than ever, all options on the table. These aren't solutions. These are slogans. The government backstop isn't a promise. It's a delay. And delays make collapses worse. The first pensions to collapse will not be public pensions. They will be corporate pensions. Why? Because corporate pensions rely on market performance, corporate profits, shareholder pressure, stable interest rates, predictable long-term returns. But today, we have volatile markets, declining profits in key industries, shareholder demands for quarterly returns, higher interest rates crushing companies, debt levels at historic highs, and many corporations have already made the shift from defined benefit to defined contribution, from guaranteed income to investment accounts, from security to self-responsibility. Corporate pensions are disappearing because they are too expensive to maintain in a world driven by short-term shareholder value. The collapse of corporate pensions is already happening, silently. The next wave will be public pensions, and then the federal systems. Pension systems don't collapse slowly. They collapse instantly. All it takes is one event, a 20 to 40% market crash. This is not hypothetical. It is historical. In 2000, pension funds lost billions. In 2008, they nearly collapsed. In 2020, they required emergency support. In 2022, the UK pension system almost broke due to leveraged derivatives inside pension portfolios. That UK crisis revealed a terrifying truth. Pension funds now rely on leverage, debt, to survive. When the market moves the wrong way, the system doesn't bend, it breaks. And here's the flashpoint. If a major recession hits while interest rates remain high, pension funds will face margin calls, liquidity crises, asset fire sales, insolvency cascades, government intervention, and mass benefit cuts. A crash doesn't just hurt retirees, it collapses the entire structure. Pension, bonds, real estate, banks, governments. A pension collapse is not a retirement crisis. It's a systemic crisis. One of the most common solutions politicians offer is simple. People should work longer. But here's the truth. Working longer does not save the pension system. It destroys it faster. Let's break this illusion. Reason 1. Older workers cost more. Healthcare costs explode with age. Older workers earn more, require more medical support, and become less productive in physically demanding jobs. Companies already discriminate silently. Hiring freezes for older applicants, early retirement incentives, replacement with automation, higher insurance premiums. Working longer is not an option if the labor market refuses to hire older workers. Reason 2. Keeping older people in the workforce blocks younger generations. Every older worker who stays in their job is one young worker who cannot enter. This worsens contribution rates, wage growth, economic mobility, tax revenue, pension inflows. Young workers are the foundation of pensions. If they can't get stable jobs, pensions cannot survive. Reason 3. Life expectancy gains are not evenly distributed. Wealthy people live 10 to 15 years longer. Poor and middle-class workers do not. This creates a brutal reality. The rich collect pensions longer. The poor die before receiving them. This was never the intended outcome. Reason 2. Keeping older people in the workforce blocks younger generations. Every older worker who stays in their job is one young worker who cannot enter. This worsens contribution rates, wage growth, economic mobility, tax revenue, pension inflows. Young workers are the foundation of pensions. If they can't get stable jobs, pensions cannot survive. Reason 3. Life expectancy gains are not evenly distributed. Wealthy people live 10 to 15 years longer. Poor and middle-class workers do not. This creates a brutal reality. The rich collect pensions longer. The poor die before receiving them. This was never the intended outcome. When corporations realized pensions were unaffordable, they replaced them with the 401k and sold it as freedom. But the 401k is not freedom. It is a transfer of responsibility from companies to individuals, and it contains fatal weaknesses. Fatal flaw number 1. It depends on market performance. If markets crash near retirement, decades of savings vanish instantly. This isn't a risk. This is a certainty. Fatal flaw number 2. It requires financial literacy most people don't have. Retirement now requires financial analysis, portfolio management, risk modeling, tax planning, withdrawal strategies. But the average worker can barely afford a financial advisor. Fatal flaw number 3. It was never meant to replace pensions. 401ks were created in 1978 as a supplement, not a replacement. By the 1990s, companies figured out, why pay lifelong pensions when we can let workers save for themselves? The 401k became the new normal, a system that benefits Wall Street asset managers, corporations, high-income earners, but it punishes low-income workers, middle-class households, people with unstable careers, anyone who starts late, anyone who experiences a recession, anyone who lives too long. Fatal flaw number 4. Most people don't save enough. Here's the nightmare. 57% of Americans have less than $1,000 saved. 73% have no pension. 40% have no retirement plan at all. The median 401k for ages 55 to 64 is $71,168. That's not retirement money. That's survival money. The 401k was designed to look like a solution, but function like a distraction from the truth. Most people will work until they physically cannot. We already saw the preview, UK 2022. A pension-linked derivatives crisis nearly collapsed the entire British financial system in less than 48 hours. It took emergency Bank of England intervention to prevent a total meltdown. This was not a fluke. It was a warning. The next pension shock will not be contained. Pension collapse sounds like a macro problem, but the impact hits individuals in the most personal ways possible. Here's what it means for you. 1. Higher taxes. Governments will tax workers more to keep the illusion alive. 2. Reduced benefits. Future retirees will receive less, if anything at all. 3. Later retirement age. 65 becomes 67, 70, 72. 4. Lower market returns. Funds sell assets, prices fall, returns vanish. 5. Higher inflation. Printing will be the final attempt to save the system. 6. Less financial security. Your savings, pensions, and retirement accounts become unstable. 7. More personal responsibility. Retirement becomes a DIY survival plan. 8. The collapse of the middle-class dream. Homeownership, security, stability, all become fantasies. This isn't a prediction. It's the current trajectory. We built an entire society on the belief that the system would take care of us. Work 40 years, retire peacefully, live comfortably. But that world is gone. The pension collapse is not just financial. It is philosophical. It forces a question that every person must answer. What happens when the future you were promised no longer exists? What happens when retirement is no longer guaranteed? What happens when the system you trusted runs out of money? What happens when millions of people reach the end of their working lives with no safety net left at all? The pension crisis isn't just about economics. It's about reality. A reality that is coming whether we are prepared or not. Because in the end, the pension system didn't collapse. It was never designed to survive. Before you go, don't leave without subscribing. The pension collapse isn't a future problem. It's happening now. Silently, slowly, and with consequences most people won't understand until it's too late. Every week, we uncover the hidden systems behind money, power, and the global economy. The stories most people never hear, and the truths that shape your financial life whether you realize it or not. If you're watching content like this, you're already ahead of 99% of people. Subscribe now. And join the few who actually understand what's happening behind the system you live in. This is MoneyLore Insider, where finance meets mystery.